Good afternoon, everyone, and welcome to TBR Software Business Quarterly Review webcast, delving into the recent results of the TBR Software Vendor Reports and Software Business Benchmark Report. My name is Allison Crawford, and I'm your host for this webinar. Over the past several quarters, we've engaged with our readers through this quarterly webinar series to provide additional insight into the state of the software market. We've had great interactions with you, and we're excited to continue to connect with you as the TBR software practice grows. Before I pass this over to Stuart and Elizabeth, there are a few housekeeping items I'd like to cover. First, we'll be recording today's session and posting it on our YouTube site, TBRI channel. We encourage you to visit our channel to watch this presentation or any of the others that we've posted. Second, we'd like to hear your opinions and thoughts on the materials we're presenting. Please send any questions or comments to the Q&A or chat function to the right of your screen. Stuart and Elizabeth will address them at the end of the presentation. Or if you'd like to set up a client inquiry for a more detailed discussion, please reach out to them directly at the end of the webinar to set up that conversation. Third, we'll send out the slides to everyone registered for today's webcast within 24 hours of the conclusion of the webinar. You can also find these slides as well as other thought leadership pieces, webinar decks, and commentaries on SlideShare at www.slideshare.net/TBR_market_insight, and I'll share all these social media links with you again at the end of the presentation. Now let me introduce Stuart Williams and Elizabeth Hedstrom Henlin. Elizabeth is our lead analyst covering enterprise software and has been working closely with the vendors covered in the report to understand their business models and strategies. Stuart leads our software and cloud research team and has been influential in developing Source IT, a cutting-edge research program focusing on buyer behavior in verticals like retail, manufacturing, healthcare, and energy and utilities, among others. And with that, let me hand this over to Stuart.
Thank you, Allison, and thank you, everybody, for joining us today for our ongoing webinar series looking at the software industry. Today's presentation is drawn from multiple published sources that we're sending out on every quarter. The first one is our Software Vendor Benchmark, which takes a business eye view into the performance of the top 30-odd vendors in the software space, enterprise software space, and also draws from our vendor-specific reports that are published on a quarterly basis. And in this particular webinar, we're going to look at a couple of the activity areas where these firms have been engaged with to drive their business, notably alliances, vertical applications, and portfolio interoperability. So with that, let's go to the next slide. So what we're looking at in 2014 for the software vendor space is a shifting marketplace where vendors are reacting to the shift of end buyer behavior for different modes of consumption. It's not new, it's the cloud, it's mobile application consumption, it's the fact that people in the IT department can go and get compute and storage assets on demand. So the shift of buyers away from buying piece parts and buying offerings that give them an outcome or the ability to get to an outcome without having to manage all the intermediary IT, particularly the software, is a key driver in what we see disrupting the industry. And so for the first half of 2014, we're looking at install-based defense, people who still are purchasing on an own and control basis, looking at buying the license and the maintenance. These are folks that are the traditional target for the software vendors. It's where they get their highest margin business. And in this case, it's all about ally versus develop, right? So the ability to rapidly extend and grab share of wallet across the customer base is key to this strategy, right? So if you have a partner who brings a solution that will drag through your offering, that's a key strategy. Another one, obviously, is in-house development, and that's really only limited by how agile the firm is at being able to drive its portfolio forward. Now, in the second half of 2014, we see a shift in the business where we see moving from install-based defense towards profitable customer acquisition. And that's really drawn in two parts. One is growth, right? So acquiring new customers via partner-led sales and the opportunity to sell to the partner's customers. So it's not just the drag through. It's really being able to build that net new customer base. And the second part of this is being able to take the flagship products and drive those through. So all of the vendors that are in our portfolio here have certain key portfolio offering flagship products, and really maximizing the footprint and revenue for those despite the deployment models is important. A key element here is, say, for database. So if we have end customers who are buying cloud services, an application through a cloud provider, well, that ISV who's developing it needs a database. So there's a shift of the marketplace and being able to land your database in with that ISV who's delivering the cloud service rather than selling it to the end customer. Because at that point, they're looking for that solution. So this is a shift of the market. It's a shift in the capabilities of the sales teams, and it represents a significant business risk for those firms that are making the transition. And we'll see that marked out in the business results that we're going to go through in a second. So what I'd like to do now is also have some commentary on this from my partner here, Elizabeth Henlin.
Thank you, Stuart. So I think the way where we can wrap this up and look ahead to what the vendors are doing in this space is talking about the end customer. We're seeing an ongoing retraction of customer spending. I think the recent shutdown of the U.S. federal government, as well as the ongoing macroeconomic conditions in mature markets within EMEA, can't be underemphasized in the ongoing crush for customers to do more with less. So when we look at customers trying to maximize how to get the most value out of what IT spending they have, that's where we look at applications-led growth and where we look at vendors focusing on keeping the customers that they have and making targeted choices around alliances or development to make sure those products are aimed at their install base needs to keep competitors out of their footprint. And then in the back half of next year, that's where you see more disruptive players looking at growth opportunities and more established players looking at maintaining margin depth and margin effectiveness going forward. So moving on, we'll take a look at the vendors within our covered benchmark. And it's worth noting that though, for those of you that receive our benchmark, the format is similar. This graph does not actually appear within the benchmark itself. On the vertical axis, we're looking at average annual revenue growth in a trailing 12-month view for the covered vendors. And on the horizontal axis, we're looking at their revenue growth for second quarter 2013. And when we look at the vendors in the balance of this year and where they're going, we really see those vendors that can target either business or industry applications value, or being a critical partner of the delivery of those applications. And I'll call out VMware and Red Hat and Citrix in particular in that statement. The closer you are to customers' incremental points of spend, the better off you're going to be in the balance of this year into next year. How do you keep the customers you have? How do you maximize the revenue opportunity with those vendors? And how do you position yourself for a next step going forward?
Right. And when we look at this rate, we look at the industry trend, we do see a slight slowing in the growth rates. They're dropping over time, and we believe that there's a significant impact on from the non-traditional software vendors, from the cloud vendors. We look at our companion benchmark where we look at the public cloud space, and we see rapid growth and large dollar volumes in the SaaS area, which is beginning to compete strongly in this. And that's looking at depending on the segment of cloud, between 15 and 20% CAGR over the next 5 years. So it's a dramatic difference in the rate of business expansion, even if the majority of the dollars are still here. And it's blunt. We're beginning to look at this and seeing it as one impact is blunting the overall volume of this business, even though margins remain pretty static for the vendors. We'll see that on a subsequent slide.
Absolutely, and I think clearly it's a given standard that the smaller the growth base, the larger the growth momentum can be.
But when you look at especially companies like Microsoft and SAP that are they're edging close to, or in some cases IBM as well, ahead of the average, those are really the vendors that we see that are best able to pivot a very substantial portfolio and a very substantial corporate infrastructure to get closest to mobile delivery, cloud delivery. How do you get those business applications closest to the end user to keep more disruptive vendors out of your footprint? So when you're talking about applications, you really can't divorce the conversation from license revenue sales. And as Stuart mentioned, we do discuss the dedicated public cloud market within our public cloud benchmark. That webinar is coming up, I believe.
Yep.
And so we'll take a look more at the enterprise software traditional standard on-premise license. And growth leaders are really looking at how do you optimize and manage applications to outperform current standards, tying that orchestration to core value propositions and creating market opportunities that way. And I think I'll mention a vendor that has been lagging in our benchmark for a couple of quarters now. Progress Software has gone through a significant amount of restructuring, divesting of a lot of other businesses and technologies, and really focusing it down to business to management and orchestration of some very key areas. And they've really managed to move the needle in terms of their own revenue growth, particularly on the license side of things. When we look at Microsoft, again, the mobile delivery, cloud delivery, the Azure cloud seems to finally really be hitting its stride, and it is pulling through a lot of on-premise license opportunities for Microsoft. The ability to take that end-to-end story and make it real in terms of delivery is a very compelling point of purchase for customers.
Yeah, this is Stuart Williams. So the piece that we see on some of the laggards, many of whom are caught in the shift of firms to the cloud and away from installed or traditional IT deployment. So the IT service management portfolios around the x86 platforms for companies like CA and BMC, we see lagging in these spaces. Symantec, to a small degree, is caught up in its reinvention. And so these firms are being hit by larger, broader forces in the marketplace, despite the fact that each of them have different strategies for reacting to them. Obviously, BMC has gone private since our last webinar, and we'll be continuing to cover them in this benchmark. That's important for their renewal as a business, so that they can begin to focus on longer-term recovery, because the business has suffered from field execution and from cloud-delivered IT services management, specifically, against that part of their portfolio. So those firms that have the broader portfolio or are point solutions around key current IT pain points, so the people who need the tools to build and run the traditional IT models, the cloud management suites, the cloud automation, infrastructure management, are doing very well as our traditional vendors, Microsoft, IBM, Oracle, are leaders in the revenue side and doing very well on monetizing their assets. The core portfolio, the flagship products for these companies are really the ones that are dragging through the business. SAP in particular lags a little bit here in terms of the license growth. Again, their very large enterprise-driven business gives them a lot of ups and downs due to the cyclicality of their business, plus a strong core of their business is still based in recession-stricken Europe. So, we continue to see some declines there. But the in-memory part of their business is undergoing rapid growth, and we anticipate some renewal to positive growth on the license side in the tail end of the year.
Particularly as SAP has just recently unified their on- and off-prem product development in a single organization, it signals really a joint go-to-market inevitability for both on and off-premise applications, which is something that SAP to date has been very distinct in separating. So we expect that to show some uptick as well. I think the big wild card as I look at this landscape for the next 6 to 12 months is the opportunity to divest or IPO certain businesses, and I'm calling out EMC and CompuWare in particular here. The software-led businesses with EMC's recent spinoff of Pivotal, as well as the ongoing restructuring of its RSA business, really signals, I think, a company that still is trying to determine which part of its federated brands are going to carry the software and the license sale heft, and I expect that to really come into focus in the next 6 months. And then CompuWare has recently just IPO'd one of its process management divisions, and this is a company that has been a small and consistently lagging performer, but the portfolios they're bringing out under this IPO have the opportunity to catch some attention and certainly some momentum that may pull the broader organization along. So it's an interesting time to watch as vendors continue to retrench and eye not only their current customers, but where the most cost-effective means of attracting new ones next year are going to be. Speaking of cost-effective and profitability, the graph that we're looking at now is a look at second quarter period in time, corporate revenue growth versus corporate operating margin, with revenue growth on the vertical axis, operating margin on the horizontal axis. And as you can see, the balance of things tends to shift a little bit when you start putting profitability and margin into focus, and Oracle has made no secret of the fact that they've been very focused on returning their business to pre-Sun operating margins. They have done so and continue to improve that area of the business. And it comes down to, if your license sales aren't growing and you're still trying to figure out your cloud story, if you can tell the market that you're profitable and you can tell your customers that you're going to return value to them in the form of dividends or other stock-related options, that's their chance to really differentiate from competitors, and it's something that Oracle has done a very good job at, especially in the last couple of months.
So the profitability question here is really key, as we talked about earlier, in the transformation of the marketplace, because those firms that have the cash flow to reinvest have the opportunity to change and transform their portfolio, as well as to take a hit in that cash flow as they transfer from a license model to a subscription model. The leadership changes at Microsoft in the next 12 months will give that firm additional air cover as they have new priorities, new strategies, but the baseline transformation of that business from license maintenance deals to more subscription-driven models is going to proceed. IBM Software continues with its new standalone cloud business, now has increasing focus around using that as a pull-through for other elements of its services, software, and hardware portfolios. So Oracle really remains a leader in this space, looking at the core technology as a technology provider to the other ISVs in the space, applications leaders, and the end customers. Very profitable position, but the transformation of the industry puts them more in a secondary position and not directly in front of the customer. So we're waiting for Oracle to make its move and become more of a market maker on these customer-facing purchasing scenarios.
Absolutely. And then when you look at some of the vendors of less scale in this segment, Red Hat and Citrix in particular, those are vendors that are really managing to very effectively monetize the investment scale that they have in front of them. Citrix, through a cloud-led approach to virtualization, they really talk about how their products optimize a cloud, create a cloud, set up for performance. Likewise, VMware, with more scale to it at that point. But Red Hat takes a very different look at being the support and services provider for open source technology development. And they're really able to best to best keep closest to their customers by making sure that they are there to optimize and create new efficiencies for them. And then taking another look at Microsoft, I think it can't really hurt to emphasize here that Microsoft's reach into the mid-market, its channel-led approach to the mid-market is a strength that I think many vendors in this segment would look to at least partially emulate, if not fully emulate. And that degree to which Microsoft can enable its partners for self-service opportunity and growth really does create a market stronghold of position, especially around margin, profitability, and scale. That's very hard to counter.
Yeah, the scalable model shifts risks off to the partners. It's hard for enterprise-focused firms like IBM or Oracle to fully adopt that model. However, Checkpoint certainly is another great example of a firm that heavily leverages the channel resale and consistently appears in our benchmarks as a leader in overall margin performance.
And I think the wild card I'll put my money on now to come back to you all next quarter and report progress in is Adobe as they move to an entirely cloud-delivered model, really minimizing, if not almost eliminating, direct sales as a cost point. We expect them to really start showing some material shift in not only margin position, but eventually revenue in the back half of next year. So I'll keep you posted. So taking a look at the landscape as we've outlined it across the vendors we cover within our software vendor benchmark, it's a landscape where vendors are taking stock of their own strengths, taking stock of their position within the market, and really investing in the near term to shore up and defend those positions while they evaluate what to do next. And when we look at what they're going to do next, now we're going to segue into some case studies from our covered vendor reports within our Software Business Quarterly. I believe there are 10 in total now, which cover everyone from Oracle, SAP SAS, Red Hat, VMware, IBM, Microsoft, CA, and Dell Software. These vendors are really looking at how can they best be seen as trusted advisors? How can they make sure that even though their customers' desires for growth are also being met with spending restrictions, usually from the C-suite level, how can these vendors help set their customers up for success? And as Stuart mentioned at the start of this, we're looking at 3 different areas of tactical best practices. Alliances, and this is really looking at the enterprise software vendors and how they are using new and in some cases very surprising for those of us that cover these vendors for some time, partnerships to create lower cost entry points into new market segments. Vertical applications, how do vendors package existing business application strengths for rapid iteration into specific verticals, especially financial services and healthcare, to create particularly high value for these very specific customer bases. And then finally, portfolio interoperability. How do vendors continue to focus on a core product or a core platform and optimize integrations between newer offerings and core offerings to ensure that it is simple for customers to expand deployments and for the vendors themselves share of wallet revenue in the balance of the year. So when we look at alliances, and it's all about Oracle, but it's only all about Oracle and that Oracle allied with Microsoft to each vendor that we cover, and then Oracle's alliance with Salesforce.com. These alliances are really all about delivery and co-selling. When Oracle and Microsoft announced their partnership, this was about how to optimize the Oracle database as well as Java to be delivered on Microsoft Azure. So Microsoft, Oracle, both realizing that there are opportunities to bring competitive offerings through a defined, approved channel to increase install-based satisfaction, better to choose the competitive offering yourself than have your customers choose it for you, and how best to certify one another's portfolios, again, select subsets of them, to be optimized to run on competitive infrastructure. And from the end customer point of view, now you see two market leaders really looking at one another and saying, we're going to make it easier for our customers for these portfolios to work together. And in some cases, especially when you look back at Oracle in particular, its reputation for a red stack only approach or a red stack plus a red cloud approach, this and especially the subsequent announcement of an alliance with Salesforce.com, I think it, to a lot of market watchers, really appeared to be an unheard of or certainly a startling change. For me, from where I sit, I never underestimate Larry Ellison's ability to understand that a change is necessary to ensure that Oracle can optimize growth in other areas, and with co-presidents Mark Hurd, Safra Katz, and Executive Vice President Thomas Kurian, create an integrated go-to-market driven strategy that also makes sure to include the portfolio teams to move what is a company that is larger than most small countries, both in terms of revenue and employees, and move them to a new course and a new direction. Now, Salesforce.com's alliance with Oracle, when push comes to shove, right now all that is a customer win. It means that Salesforce.com isn't going to defect to an open source database anytime soon, and in fact they're going to expand their Oracle offerings internally so that Salesforce will run on Oracle engineered systems as well as the Oracle database. But there is discussion at this point already of plans to resell and co-sell applications within both install bases, so this promises to be an opportunity for collaboration going forward. Stuart, anything you want to add?
Nope. I think that the keys here really are that these are broad footprint firms that are leading the market. They obviously already have strong alliances with all of the rest of the key players, so it's a question of managing the footprint. So our clients who are on this particular webinar, really need to realize that these are fluid alliances, and that both Oracle and Microsoft are looking for positions around the edges, right? So looking for ways to take advantage of the shift to mobility, the shift of to the buyer who just wants to get a business outcome, the shift to machine and embedded systems. These require both Microsoft and Oracle to take new approaches in its go-to-market and to look at OEM relationships as well as strategic technical relationships. So, the landscape and the need for chasing the opportunity is the reason why Oracle and Microsoft, the alliance landscape is really going to shift as we go forward.
Expediency is the mother of invention.
Always, as always.
As always. So moving to vertical applications. And we're seeing a rise in discussions of vertical applications, industry applications across the landscape. What it comes down to, for me, is how are vendors really taking portfolio assets they've already got and capitalizing on packaging strengths with some additional incremental technology investments to make these core assets relevant in new markets. SAP, like Oracle, both longtime investors in a vertical go-to-market, though Oracle is the far more established of the two. We see SAP really escalating its investment in some major areas around verticals. There's a number of new executive leadership positions announced recently, and we expect those two vendors in particular to really escalate market engagement in vertical applications in the balance of this year. And candidly, they're evenly matched, but they come at it from two very different perspectives. For Oracle, it's about how can Oracle deliver applications that are optimized to integrate with and collaborate with the Oracle database. And for Oracle database customers, that's a compelling value proposition. And for SAP, it's about understanding the back office and understanding the back office application better than anyone in the market, and though IBM would probably argue with that assessment. And how can SAP extend not only its application reach and credibility, but pull through the newer offering of SAP HANA to bring an integrated application and database solution to these verticals, and if they displace Oracle in doing it, so much the better. When we look at SaaS, SaaS is an interesting company to cover within our landscape in that it is a multi-billion-dollar company that is entirely focused on a single market segment in BI and analytics. And we're now seeing SaaS starting to expand its vertical analytics solutions, and we think that really reflects the SaaS's moves to differentiate itself and continue to differentiate itself from enterprise software vendors that are moving into the business intelligence software market.
I mean, the key when we look at both SAP and SaaS is their specialization and the ability to bring deep intellectual property to their clients. The SAP, with its long time go-to-market focusing around the business needs and selling to the CEO, the C-level office, and SaaS bringing its very deep intellectual property around analytics and really being a market maker in terms of proving out the value of analytics across businesses, really positions them well as leaders in this trend to be able to go to market. Once we get outside of SAP and SaaS, and we begin to start looking at firms like Oracle has made many acquisitions to build up its industry global business units and has grown them internally as well. Microsoft is beginning to pivot and look at industries. HP is beginning to pivot and look more extensively at how it can grow its industry-led business, despite being a broad technology leader. Many firms that don't make any claim to having an industry-led focus, but who deal with partners, need to realize that their partners or their regional sales teams are going out and visiting on clients who are themselves in an industry. So to ignore the needs of an industry is to not arm your salespeople or your partners to succeed at the highest levels. TBR research shows that the number one affinity driver for end customers in purchasing is feeling that the salesperson understands their business. So having even messaging or guidance around industry transformations or stories or what peers may be doing are great ways to begin to position a largely horizontal solution against this. So, this is an incredibly important strategy for the software vendors to move forward, even if they're still thinking that I'm just a platform developer. Those platforms and the needs of unique businesses in this day and age cannot be ignored.
And interoperability. While we know that interoperability is kind of a given, it's table stakes in this business, we're really now starting to see business value narratives being tied to stories of interoperability. Portfolios have always been built to work together, but now we're seeing vendors, including the three you see on the screen, really tying integration and interoperability to a simplify IT story for their customers. When we look at Red Hat, especially recent launches that are tying Red Hat Enterprise Linux, Red Hat OpenShift, which is their cloud solution, and Red Hat Enterprise Virtualization into a single point of deployment, a single SKU, it's about how Red Hat technologist DNA can now start to create solutions for customers. They're not at a business value point yet, but they're certainly on the path to get there. In HP, and HP is, as I think known to everyone on the phone, HP is a company in transition, but we've noted multiple times in the past that HP's software portfolio remains the opportunity point for HP to really create solutions that extend well across every inch of its portfolio and create unified opportunities for go-to-market. The Haven platform really is the first new offering we've seen this year that takes the idea of software, hardware, services, and really brings a unified BI and analytics platform from engineering to deployment into a single point of purchase. And then finally, when we look at IBM Software's new value proposition of easy, fast, and smart, as it's been said for years, no one ever gets fired for buying Big Blue, and that's very true. But now they're starting to really try to help their IT stakeholders tell the story to their executives of what transformational value IBM and IBM software can bring to line of business performance.
So from our end user research, when we look at the change in behavior, we see a couple of different types. There's a traditional own and control customer who wants to have exposed all of the knobs and levers that they can use to shift their business. However, there are rising populations inside businesses, and as businesses can characterize themselves. One is a firm that wants to, take tools that integrate easily and build to a result. So this is the framework and API-driven development cycle that we see arising now, and the fact that vendors are using standards and increasing interoperability is driving adoption of a great many products. But the highest level we see are customers who are just really purchasing an outcome. So that can be because the technology is deeply embedded and the end product is surfaced in a way that just gives the end user a complete experience, or the product itself is engineered to be interoperable and a plug-and-play environment. So the consumerization trend of having apps that are easy to download and install on your phone are really becoming the mindset for the non-IT folks who want to say, hey, I want my sales application to work that easily, or I want my analytics application to be that simple, and make the back end seamless is a great way to reduce the pain points for those particular types of customers in the buying situation. So again, it's easy recommendation to make. It's incredibly difficult from a technical and competitive landscape point of view to make the decisions around how to make these in advance or expose these different areas. So with that, we're going to follow up with some questions, and hopefully, if you think of additional questions that we haven't had an opportunity to answer for you, please contact both Elizabeth and I via email. We're happy to take questions after the webinar.
Great. Our first question, what impact do you see embedded functionality such as analytics having on enterprise software market growth?
I think when we look at embedded functionality, that's the biggest opportunity for install-based defense in the next 6 months. And if you look, I'll take Oracle as the example since I'm just back from Oracle Open World. The discussion of the Oracle Endeca portfolio and how in-memory technology is also being embedded into core business applications like JD Edwards really speaks to, I think, the main enterprise software vendor strategy, and I include the big, probably 5 in this in our coverage: Oracle, IBM, Microsoft, SAP, and SAS. Those vendors are going to look at every possible way to extend the value of core platforms through embedded functionality to keep competitors out of their install bases.
And I think when we look at one of the futures for embedded analytics is obviously IBM is driving with its Watson program. When we look at the evolution of that core technology to be able to scan an information base and develop responses, and then being able to harden it, secure it, wrap it around applications and information bases is an example, a really sterling example of being able to answer questions. So as that product family matures, we anticipate that Watson will increasingly be able to answer questions and develop responses using best practices that are embedded in the literature and data from multiple areas. So the nature of what is an application really begins to shift, and the nature of the work being done is more around understanding the right kinds of questions to ask an analytic application instead of just moving the levers or knobs to generate responses.
Okay. What benefit do you see firms getting from privatization? Should we expect more of that in coming quarters?
So obviously we see some firms that have completed their process of going private, right? So Dell and BMC are examples here. Firms have been being taken off the market by Infor over time, and Infor remains a privately held firm and one of the largest software companies out there. as this is a mature industry, software is no longer just a high-growth, IPO-fueled business. We anticipate a broader balance of both publicly traded and privately held firms. There's a maturity in the industry that, particularly in the enterprise space, where there's going to be a balance. Obviously, the large firms generate the cash flow and have the opportunity to benefit from the access to public capital. But the ability to manufacture deep change in your business can only happen when you're not under the quarterly scrutiny of Wall Street. So yes, we do anticipate two things. One is greater consolidation, and part of that consolidation firms will go private and possibly be broken up by the firms that take them private, that buy out the public capital, and then possibly break them up and resell those firms.
Okay. It looks like this might be a follow-on. What segments are particularly promising for M&A?
I think business intelligence and analytics is probably the most, when you're looking at a 6-month window, SAP's recent acquisition of Kexon, I think, is a bellwether for a rise in pure play acquisitions in the business intelligence and analytics segment. It's an easy or relatively easy area to embed in a lot of business applications, and that's where we see, again, a lot of the growth opportunity in the first half of next year is around those incremental points of value add for customers. I think if I was looking beyond that, security is probably the next wave of acquisition-driven investments. I think it's a business that has proved very challenging for a lot of pure play vendors, especially in the last probably 12 to 18 months. We can look at the reinvention of Symantec as probably a great example of that. And the acquisition of McAfee by Intel as a point of opportunity for those vendors that have the cash flow internally to really think about that kind of a scale investment. Customers continue to care about it, and it's the opportunity to really make sure that your solutions are secure and that you don't have to rely on a partner to get them there.
And I'm just going to have a little slight difference of opinion with Elizabeth. I think her categories are sound, but I believe that mobility firms that have platforms, tools, and rapid mobile application environments are really key. We've seen IBM make a couple of acquisitions in this space on top of their acquisitions in data and analytics. Data management is a key component of the BI and analytics space, so there's a play there. We also see strong growth and interest in embedded systems, so probably your non-traditional software vendors, firms that are both in the device and software field. So we have medical devices, we have industry-led devices, so there's a play there. And finally, that leads us to machine-to-machine, so firms that offer the ability to manage, consume, and get insight from machine-to-machine data and pull those into human systems of interaction are incredibly important, and we see a rising awareness of that inside the end customer base.
Great. We are out of time, so I want to thank everyone that joined us today, and thanks Stuart and Elizabeth for the presentation. As I mentioned, here are all the social media links, and I encourage you to follow Stuart, Elizabeth, as well as TBR on Twitter at the handles listed here. We're putting out opinions and links to research and commentary on a pretty frequent basis, so please follow all of those links to make sure that you're keeping abreast of what's happening here at TBR. As well as the SlideShare and YouTube pages. We'll be recording today's presentation and putting it on YouTube, so you can share that with colleagues that weren't able to attend today. And we will be sending out the slides to everyone by tomorrow. As Stuart mentioned, if you'd like to have additional conversations, please reach out to them at the email addresses listed here. And before you sign off, there's a short 3-question survey about today's webinar. We are collecting your feedback and using that quarter to quarter to make changes, to make sure that you're getting value out of the time that you're spending with us on these webinars. So we appreciate that feedback. I'm going to leave the chat function open for another couple of minutes in case there's any last-minute follow-up questions or requests for conversations. And if we don't hear from you this time, we will talk to you guys all again next quarter with new updates on what's happening in the enterprise software market. Thanks, everyone, for attending, and have a great afternoon.